All right, everyone. Welcome to the Hurley Investments Trade Findings and Adjustments of May 5th. I'm Keith Bybee. I'll be hosting today. I'm taking over for Kevin Hurley. It is his birthday, Cinco de Mayo. Happy Cinco de Mayo as well. All right, let's get right to it. What an interesting market. We have record unemployment that will probably continue to go up. Economic numbers that just look terrible. Earnings that are mixed. Some are absolutely awful, and then few of them are, few of the ones taken off have had good earnings. And yet we have the stock market going up a record 13% in April, the highest gain in a single month. So, given these cross currents, what's next? What's up for the summer, the months ahead? What is going to happen? Kevin went over a little bit of some of those thoughts yesterday, but I kind of want to get an idea of what you guys think. Do our markets continue to go up and ignore all of this economic turmoil and bad earning numbers with crappy guidance or no guidance, or, well, I guess I shouldn't say crappy guidance. It's just not there. But what do you guys think? Just taking a look at our S&P index chart over here. There's like a somewhat of a channel going up this way. Kevin talked a little bit about maybe a pendant. I'm not doing a very great job of drawing it, but kind of in this no man's land we always talk about. What are some other thoughts? All right, so I'm going to let you guys think a little longer, mostly because I'm not seeing any comments come in. No images? Oh, well, maybe that would help. Thanks for letting me know. All right, why don't I show the screen? There we go. All right, let me draw that one more time. We have somewhat of a channel support level going off like this. You're welcome. Isn't it nice to have the ability to see what I'm talking about? All right. That's all I was referring to. So I guess the question is, does the market continue to rally based on what? Stimulus? And you know, it's kind of a bummer because nobody really knows, nobody has anything but questions, right? So I'm not going to pretend that I have all the answers, but I think it's important to continue to look at and remember the right questions to ask. And the comments from Mnuchin was that they could continue with more stimulus, with a record 2 trillion, and it could be more. Just insane. So as I'm kind of thinking through that, let's look at Disney. Just as an example, you do have Facebook, well, really all the FANGs, and that's what's pushing up the market, and specifically the tech sector, obviously, and for the year nearly hit positive, which does just sound insane. But let's look at Disney. Disney's one of those that, now they just came out with their earnings today, and they obviously did awful. They missed their bottom line and held on to their top line, but their revenue from all of the parks and whatnot, obviously not coming in through this period of time as they're closed, but they had something like 50 million more subscribers from the last earnings quarter, which back in February they had come in around like 26 million. So quite a bit of subscribers, and obviously that helps offset that. But then the other negative was no movies, right? So look at CNBC. Disney's down 2% after hours, which, you got to be honest, is not as bad as you would think. Some of the positive things were they do have Shanghai reopening within a week. They've got their movies that they've pushed back, and Milan is supposed to come out in July now. A couple others they're still sticking with coming out in theaters. There was one that they were going to just release on Disney Plus, Artemis Fowl, but generally they're just biding their time and trying to wait for opening through theaters and doing that sort of thing. So I don't know. Disney's a good example of a company that, like I said, has some mixed issues, right? So can you see yourself going to a movie? Can you see yourself going to a park? And part of the parks, they were just on how they were talking about in Shanghai was that they're going to open the gates slowly. So they have, instead of, I can't remember the capacity, but they'll run at 20% of their capacity, testing people for fever, stuff like that. And slowly, as the weeks go by, going back to full capacity. So you got to think that in January they were closed in Shanghai and have been closed since that period of time until now, or at least in a couple weeks when they open. You got to figure that US and their Europe, their France park has got to be pushed back till maybe sometime in the fall, I would assume. So the question is, let me just go back to here. So what happens to that lost revenue? Is it replaced by stimulus? Maybe it helps some of the workers off. I know a lot of companies have still had to lay some people off, and some people are on unemployment and that whole thing that obviously will expire, but could be, pushed back. So that's kind of the big question. And it goes for not just Disney, but everything. Does the money push through to companies that hold on to their employees and otherwise kind of going to people individually and going to families' bank accounts, as well as unemployment money? Does that get pushed back into corporate earnings? Does it go back in that regard? And of course it will in some ways and in some sectors and some businesses. But man, are you guys going to go back to the theater this fall when maybe coronavirus comes back into play, or the next flu season, getting back into the colder months? Are you going to go see a movie? Are you going to fly anywhere? And if you're going to fly somewhere, are you going to stay at a hotel? Are you going to go on a cruise? That's going to be a tough one, I think, through the year. I would think some places are going to be okay, or at least do a little better during the summer, as supposedly we have a little better chance that coronavirus kind of fades in the summer, but warmer months and whatnot. But I am not sure. So, all right. Let's go back to, let's look at some ideas. Since we have more volatility, there's a thought of covered call. I know some of you have mentioned some success with naked puts, way out of the money. When there's so much uncertainty, I struggle with recommending something like that. So I'm trying to think about maybe a target covered call, and one I had done earlier in the year, and when everything kind of started to sell off, got stuck with it, caller traded it, ended up with another 100 shares when things came back down towards 95, and have ridden that all the way back up. Target is one that does like to go sideways. They had same store sales come out a few weeks ago, and it dropped. You see this part, and has rallied back up. The reason for which was because they had costs going up, and a lot of their high margin items were not being sold, but otherwise had crazy store and online sales, pickup sales, that kind of thing, that were higher than Cyber Monday, which was kind of crazy. So a little bit of a cross conflicting signals, I guess, but my thought is, and let me go, let's see, get power trade. My thought is, gotta get rid of the pen. To be out before May 20th. Dividend. So you'd get, I don't know if you would miss, I think you would miss the dividend, as you'd probably want to be out before that on the 19th. Just looking at options for 10 days at almost 112. If you went right at the money, get 245, which is what I would suggest. Because the idea is to book a profit of that 245, around 230, right? 235 for a 10-day trade covered call. Just looking at, so you would be called away by the 15th is the third Friday, which gives you time to get out of it before earnings, right? So here is what I would look at. You be the judge on quantity. Sell 235. So that's something that I would look at doing. Kind of because I'm doing it. Or you can wait and see if technically it comes back to touch this 200 a day and go to maybe a 110. But you're getting some decent credit there. And let's see, about 235. And just to look at target, unchanged after hours. So I'll say roughly. If it goes down, at what point would you protect with a put? Is a question I got in. I'll answer that in just a sec. Just let me get this. Screenshot on here. Good question, Rich. I would probably have my line in the sand be that 200 day. If it closes below that, or you could look at this pivot point down at 104.66. But that point you could still just get out at a little bit of a loss, minus that credit you took in. But because again, I don't really want to roll through earnings. So I would consider, if I were you, just at that point taking it off the table and looking to the next one. Looking to something else to make you some money. All right, so that's an idea. Other thoughts? Visa is kind of, it was up a bit from their earnings, but looks like it could struggle to get above 180. So I might look at doing something bullish with Visa once they break that resistance level. But we're not there yet. Facebook did amazing and is one of those ones taken off. I think Kevin had mentioned or talked over this one last week or so. And yeah, another one that I guess one of the few that's doing good through this period. They typically do have a lot more subscribers, or not subscribers. They have more active users through these election months leading into November. So I would suspect that they wouldn't necessarily lose users and activity. So I would look at, if you haven't already, a leap for Facebook. 210 might be somewhat of a resistance level, but you know, if it doesn't continue to go up or it comes down to test the 200, that's the point. That's 200 day or the 200's price even. That's the point you maybe leg in with another leap. Or if you can't afford a couple $1,000s for a 2022 January or June 2022, then I would just look at, they don't have June 22, so let's look at January. 250s. That's where we have a few. Gets a little more expensive in here, closer to the strike, closer to the share price at 200, 207. So I would look at 250. That gives you a little cheaper, out of the money, gets you out a ways, plenty of time. But yeah, I would leave some room to maybe leg in case it comes back to test that, and even more room in case something crazy happens and we get more regulatory nonsense that Facebook has been plagued with for the last year and a half, 2 years, and see it fall all the way back down to 175. But yeah, so Facebook, I'm going to say, and I guess if I'm already saying the same thing Kevin did last week, I just can't remember off the top of my head, but I apologize, but look at January 22. I'll just say 2022 so it's not so confusing. $250 strike. So leave room for another contract if it goes down to test the 200-day. I'm going to say also leave room if it continues to go down, right? Meaning that we're dollar cost averaging, you know, if it goes on quite a bit of a sell, but and again, the rule of thumb is if it loses half of its value, the leaps lose half their value, is the time to double in. I'm going to say leg in two. So if you don't have the ability to leg in with a couple more contracts or one contract, if you already have just one, then just go with the one or the couple and just let it sit, so that it does come down, you have that ability to reduce cost basis and dollar cost average should it go all the way back down to 175, 170, and see those lose some value. So repeated myself a couple times, so I hope that is clear and it makes sense. Guys, any thoughts or questions? I guess part of the concern would be, you know, should we look at some of the ones that have gone on sale? And I mean, we've talked a lot about that. And we're already kind of in some of that stuff. We've already kind of dollar cost averaged. You've seen some of the things Kevin has showed with his account, our accounts together, specifically Boeing, which, you know, has a ridiculous sale, crazy cheap, dollar cost averaging it and trying to make it profitable out into the future and dealing with that as we need to. But I guess what I'm trying to say is, depending on what you've been in and what you haven't gotten into, I would just be cautious. I like a little more something like a Facebook that is shown that they're not only hanging in there through the current circumstances, but actually doing better. Trying to think of some more things. I wouldn't necessarily look at video games. Because they're at their all-time highs. Activision or TV. It's just hard to say that they're going to keep up with this long term as a bullish trend. But yeah, I guess I'm just trying to say, if you're trying to find some that are on sale and beat up and find super cheap, just take stock of what you already have that you've had to dollar cost average, because chances are you're having to deal with lowering your cost basis on those types of things already, that it might not be worth trying to find some of the stuff that's struggling as new positions. I hope that makes sense. Question in, with Target having earnings on May 19th, are you going to buy long put? Seems expensive with May 22, 13. Yeah, so again, the idea is to be out of it and called away for full profit before that point, which is why I used the May monthly right here, expiration, to hopefully get called away before that point. So, I mean, I guess it's up to you if you want to run through earnings. Target's one that I could go either way. I imagine would do okay because of what their same store sales had, but not necessarily taking off either. So that's my thought. So yeah, I would try and avoid that. But if you had to, yeah, I mean, you're in it to protect yourself for earnings. Should it can just go down quick. Just look at the chart again. So I guess that's just what you have to decide personally. If this is something, if it comes back down and falls through this 200-day rather quickly, that's the judgment call you're gonna have to make. Are you okay living with this through an earnings report and hopefully coming out of it positive down a couple months down the road or longer? Because again, you're right, Ida, those puts are expensive. And all we're trying to do is make money off of high volatility on a company that has done okay sales-wise through this period. Does that help? Does that give you the thoughts that you need to, I guess, make the decision for yourself? So I guess do the math. If it's $6 to protect and it's already fallen, maybe it would be more worth it to just count it as chalk it up as a loss, missed opportunity, and find something else. But that decision has to happen before earnings. If you like the idea of Target or holding it, yeah, you're gonna have to be okay with paying a bit for protection through earnings, but not what I'm suggesting here. Perfect, thanks. Well, good. Guys, any other questions or thoughts? Just looking at a few of our usual suspects. Bank of America on this bullish channel, struggling to stay above a 50-day and a pivot point here. We have protection on that one for our shares, and just looking for an opportunity to either see if it's going to break up, hold that support, or break away to the downside where we'll need more of that protection. I guess part of my concern here is because there's so many cross currents of both stimulus, where everybody's saying you can't fight the Fed, don't fight the Fed, this and that. Companies not being able to give great guidance or really any guidance, and mixed results on their earnings. I just feel like my personal feeling, and I know I've just given questions so far, but my personal feeling is that the summer, because of those different cross currents, is going to be somewhat flat, and not just because usually the summer kind of goes sideways in a normal year, but that would be my concern. So things like leaps and credit from covered calls, that kind of thing is what I'm looking at. And Bank of America, if it just doesn't want to hold support and stay up, continue that bullish trend even after their earnings falling down, and then I guess this was their earnings back here in mid-April, and then rallying back up. I just feel like some of these share positions that we have are going to have covered calls to get through some of the higher volatility, or profiting through the higher volatility in a sideways, somewhat sideways market. And maybe the market will continue to go up, but you have to pick the ones, at least in our portfolio, that might not necessarily follow that. So that could be a Bank of America, it could be a JP. Almost looks the same, except it's a little further down from, I guess you could say, is just under resistance level here at this pivot point. And of course, we'll see how Disney reacts tomorrow, because it is a surprise it's only down 2% after hours. That maybe that'll be another one that will kind of have a sideways summer. Visa did so well. I would think that there's a better chance it heads up, but you never know. One to keep your eye on. Guys, any other thoughts or questions? I think that's it for me. I hope in a roundabout way I've made my thoughts a little more clear. Yeah. We live in interesting times. All right, not seeing anything come in. Thank you guys for joining me. As always, Kevin will be back Thursday, and I'll be joining in to listen with you. So have a good one. Take care and be safe. Good night.